If you've been looking at the market lately and feeling like it's playing by a completely different set of rules, well, you're not alone. In this explainer, we're going to dive into this huge puzzle and figure out why everything you thought you knew about investing might just be wrong. Right. So this is the central mystery, isn't it? It's got investors and even the experts scratching their heads. You have all the classic warning signs flashing red: super high valuations, recession talk, and yet the market just keeps climbing. What is really going on here? To really get what's happening today, we have to start with one simple, kind of jarring fact. The old rulebook, it's been completely tossed out the window. All those indicators that guided investors for decades, they just don't seem to be working anymore. You know, for years, the rules were crystal clear. If valuations got too high, you knew a correction was probably coming. If you heard recession warnings, you knew it was time to be cautious. But today, the market's acting like those dangers don't even exist. It's a total disconnect from reality as we knew it. And just look at how extreme things have gotten. The market's trailing price-to-earnings ratio, a key valuation metric, is now pushing 30. Now, to put that in perspective, we have not seen valuations this high since the absolute peak of the dot-com bubble. By any historical yardstick, this is deep, deep in the red zone. So, what changed? Why are the old rules suddenly failing us? Well, it's because we've quietly ended one massive financial era and stumbled into a completely new one. For decades, the system was predictable. You had central banks like the Federal Reserve, and they were the ones in the driver's seat. If the economy got too hot, boom, they'd raise interest rates. If things cooled down, they'd lower them. Their moves were the #1 signal for investors. Everyone understood this game. But then, this happened. Between late 2022 and the middle of 2023, a chain of crises popped up that really threatened to bring the whole system down. And in every single case, it wasn't just the central banks that acted. No, governments stepped in with overwhelming, unbelievable force, guaranteeing everything and bailing out massive institutions. This right here was the turning point. And those interventions, they didn't just put out a fire. They fundamentally changed the game itself. They kicked off a whole new reality with a completely different set of rules that, honestly, we are all still trying to figure out. Welcome to the era of fiscal dominance. The big idea here is that markets now believe that governments, with their ability to spend and issue guarantees, have way more power than central banks. Basically, the government is now the player at the poker table with all the chips. And think about what this does to an investor's brain. The psychology has totally shifted. We've gone from a world of trying to figure out and price risk to a world where we just assume the government will step in and absorb any big loss. The very idea of a true system-wide crash has, in the minds of many, been taken off the table. Okay, so how does this new belief actually move markets? It's not just some vague feeling in the air. Oh no. It's a powerful engine, and it has two main parts that are driving everything higher and higher. So you've got these two forces working together, and they create this incredible feedback loop. The belief in the government safety net makes these huge, automated funds feel safe to buy. Their buying pushes the market up, which then just reinforces the belief that, hey, nothing can go wrong. Let's talk about that first force. The effect is profound. When the market literally stops pricing in the chance of a big crash, there's no buffer for things going wrong. Assets get valued as if we live in a perfect world, all because investors believe the government has guaranteed that perfect world. And this quote it nails the core issue perfectly. The risk, the zombie, it's not actually gone. It's just been buried under all these layers of government promises and market confidence. But, zombies have a nasty habit of not staying buried forever. All right, the second force is more mechanical. We're talking about these massive behemoth funds, passive index funds, algorithmic trading systems. These things are basically on autopilot. Their models operate on simple, backward-looking rules. If the market is going up, their rules say, buy more. They don't ask why it's going up. They are just forced to buy into the momentum. And just to give you an idea of the sheer scale we're talking about, one firm alone, BlackRock, manages over $10 trillion in assets. The automated decisions of funds this big don't just react to the market. Their buying and selling is so powerful, it literally creates the market's reality. This quote from an anonymous fund manager says it all. This is the new logic on Wall Street. It's not about value, it's not about fundamentals anymore. It's just a giant self-fulfilling prophecy driven by enormous size and unstoppable momentum. You buy because the rules say you have to. And guess what? Everyone else's rules say the exact same thing. So, where does this leave us? What are the consequences of this bizarre new game, where risk is invisible and buying is on autopilot? Well, it's leading us into some very strange, very uncharted territory. This is really important. We shouldn't think of this as a normal bubble, like the dot-com craze, which was all about human psychology and euphoria. This is different. This is a structural bubble, created by the new mechanics, the new plumbing of the market itself. And that, well, that could make it way more dangerous. And that brings us to the final, absolutely critical question. This entire structure is built on one single belief, that the government can and will fix any problem that comes along. But what happens if that belief starts to crack? What happens when that zombie starts digging its way out? Well, one scenario, one where the market loses faith in that government backstop, it's pretty chilling. A calculation suggests a potential market decline of 75%. That's a collapse on the scale of the Great Depression or the dot-com bust. What this implies is that the risk we all thought had vanished hasn't gone anywhere. It's just been compressed, building up immense pressure right under the surface. So the final question for every single investor is, when and how will that pressure finally be released?